everybody? It's your boy Deshaun back with another trading video. And today we're going to be going over the Forex trading basics, okay? Forex 101. So what I'm going to be going over is everything that you need to know when you're just getting started within the foreign exchange market, all right? Whether it comes to pairs, pips, lot sizes, buy and sell, charts, risk management, everything that you need to know in order to actually go ahead and have some type of basics or understanding on how actually the market works, so on and so forth. Okay, so the first thing that we're going to talk about is what is Forex. Okay, so Forex, in other words, equals the foreign exchange market. So with the foreign exchange market, you're actually able to trade a variety of different currency pairs. So for example, you're able to trade the euro, you're able to trade the US dollar, you're able to trade the Japanese yen, you're able to trade metals, you're able to trade stocks, you're able to trade a variety of things within the foreign exchange market. Okay, this is probably about over a $6 trillion per day market. Okay, there's a lot of money circulating within these markets. And when I first heard and started learning about trading, and I seen how big and broad of a market this is, all I basically told myself is within that $6 to $7 trillion that's circling per day, all I need is, a couple hundred a day out of that, a couple thousand a day, so on and so forth. Okay, so basically the Forex market is where one currency is exchanged for another. So for example, let's say we have our currency pair Euro USD. So what that means is that you're going to actually be going ahead and putting the euro against the US dollar. Okay, so the first currency is euro, which is EUR, which is the base currency, and then you have the USD, which is the quote currency. Okay, and basically price fluctuates on a day-to-day basis, and you're actually able to go ahead and profit whether the market goes up or down. Okay, so basically traders speculate on whether one currency will strengthen or weaken compared to another. So for example, if we want, right, the euro, if it tends to be stronger than the US dollar at the time, then the currency pair Euro USD will start trending upwards. If the euro is weaker than the USD currency at the time, then Euro USD will start trending downward. Okay, so Forex is commonly quoted in currency pairs such as Euro USD, GBP USD, USD JPY. Okay, so one thing that is very, very cool about the foreign exchange market and compared to stocks is that the foreign exchange market operates 24 hours a day within different sessions of the time. Okay, so it's open 24/5. Okay, so next, the next thing that you need to do, you're going to have to learn about, is understanding currency pairs. So major pairs usually include the US dollar and are among the most actively traded currency pairs. So a lot of people like to trade the US dollar for the simple fact that the US dollar is kind of basically one of the most powerful currency pairs throughout the whole entire world, not even just the country of the US, but within the world. If you go to different countries, there are a lot of countries that allow you to actually go ahead and exchange and also pay for items with your US dollar. Okay, so we have your major currency pairs like Euro USD, USD JPY, GBP USD, so on and so forth. Then now after that, we have your cross currency pairs, which is kind of something like Euro GBP or GBP JPY, so on and so forth. Okay, so now the next thing we have is your exotic currency pairs like USD Tri, USD Peso, and all these variety of different other things. So as you continue to learn about these different currency pairs, you'll be able to identify which one works for you, which one you like to trade the most, so on and so forth. Okay, so beginners often focus on liquid major pairs because spreads may be tighter, but risk still exists. So every pair within the foreign exchange market, it has its own type of behavior and own type of volatility. Okay, so there are some currency pairs that are more volatile than others. So if I'm just getting started, I'll be looking at currency pairs such as Euro USD, GBP JPY, USD JPY. I'll be looking how to actually go ahead and trade those. Also AUD USD and NZD USD. So you should start by looking to trade those currency pairs before you start going to other things such as NAS 100, US 30, gold, silver, all these different types of things, because gold, silver, and US 30 and NAS 100, those are very, very volatile. And you have to have some type of, experience, I believe, to actually go ahead and benefit and trade from those currency pairs. So definitely, if you're just starting out, what I recommend just to start learning how to trade AUD USD, Euro USD, GBP USD, USD JPY, NZD USD, just a few pairs to name. Next, so now Forex gives traders the ability to speculate and enter trades on either direction. So now let's say we have our currency pair Euro USD, and we believe that the euro is going to be stronger than the US dollar. So that means that we're going to be looking to take buy positions in the market. Okay, so basically you buy when your analysis suggests the base currency may rise relative to the quote currency. So if I believe that the euro is going to be stronger than the US dollar based on my strategy, I'm going to be able to actually go ahead and buy within the market. Okay, so now what you're actually able to do is also you're actually able to profit in sells in the market. So this is what I really, really like, about the foreign exchange market, because you're able to profit whether the market goes up or whether the market goes down. Okay, so for sell/short positions, okay, for example, let's say we want to go ahead and sell Euro USD. If we're selling Euro USD, that means that we are expecting the euro to be weaker than the US dollar, okay? In your sell positions, all right, you'll enter sells when your analysis suggests that the base currency, which is the euro, may fall relative to the quote currency, which will be the US dollar, okay? So the direction should come from a trading plan, not just guessing. So that's why it's very, very important also to actually go ahead and find a strategy that's going to work for you. Okay, so the next thing that we have is, what is a pip? So this is something that's also very, very important, because a pip is basically a standard unit used to describe price movement in any Forex pairs. So pips are going to be determined how you're going to be actually go ahead and start making money, okay, within the market. Start learning about, how much money you're going to make, how much money you're risking, so on and so forth. Okay, so for many pairs, one pip is the fourth decimal place. So for example, you have 0.00001. Okay, so now that will be the decimal point for where you start calculating pips. So if you take a look to the right, where we have the green photo, we can see 1.10000. Okay, then now let's say the market moves to 1.1010. So now what that means is the market has moved equivalent of 10 pips. Okay, and depending on your lot size, let's say we use a 0.01 lot size, that's going to be $1. Let's say we use a 0.10, that's going to go ahead and be $10, so on and so forth. But we're going to get into that eventually later on in the video. Okay, so JPY pairs are commonly quoted differently, with the pip typically at the second decimal. Okay, so your dollar profit or loss per pip depends on your position size, the pair price, and the account currency. Okay, so it's very, very important to actually go ahead and identify what a pip is in the market. Like I said, you want to calculate it by the fourth decimal point of the price. Next, lot size and position size. So a lot describes trade size. So brokers may offer standards, minis, and micro size positions. Okay, so within the foreign exchange market, okay, it's a little bit different. Okay, so as you can see, you have standard lot sizes, minis, and micros. Okay, so standards, minis, and micros, it's a little bit different from Forex than what it is to actually futures. So futures are basically actually go ahead and measure by contracts, where Forex are measured by lot sizes. Okay, so a large position means each pip movement can have a large financial effect. Position size should be calculated from your account size, stop distance, and planned risk, not from how much money you want to make. So Later on in this video, I believe we're going to be going over also risk management. So let's say, for example, okay, I'm looking at a trade and I want to actually go ahead and catch 10 pips. Okay, so let's say I use a lot size, like I said, of 0.01. That would be $1. Now, let's say I use a lot size of 0.10. That would be $10. Let's say I use a lot size of 1.0, which is a standard. That will actually go ahead and be $100. Okay, so learning about pips, lot sizes, position sizes is very, very important. Okay, so smaller size, lot size, you'll have smaller amount of exposure. Obviously, the higher the lot size that you enter your trades, the more money that you're actually going ahead and risking. Next, candlesticks. So it's very, very important to actually go ahead and learn what a candlestick is. So each candlestick, okay, whether it's green, which will stand for a bullish candlestick, and then you have red, which stands for a bearish candlestick. So each candlestick summarizes price movement over a chosen time period. So within the foreign exchange market, there are different types of time frames that you're going to be able to identify and learn how to actually go ahead and analyze the market. So there's going to be times where, let's say, you're going to be looking on a 1 hour time frame, the 4 hour time frame, so on and so forth. And whatever time frame you on, each candlestick, whether it's a bullish candlestick or a bearish candlestick, at any particular time shows basically the price action of that time frame. So let's say we're on an hour time frame, and then we have a bullish print candlestick printing at 8 p.m. let's say Eastern Standard Time, right? From 8 p.m. to 9 a.m. Eastern Standard Time, there will be one candlestick of price because that is going to be within the hour range. So now let's say we go to the 4 hour. Now it's going to be one candlestick that's going to be for every 4 hours. Let's say the 15-minute, the daily, so on and so forth. Okay. So within the candlestick, the body shows the relationship between the opening price and the closing price. Okay. So now we have something that's called a wick. So within a candlestick, you have a body and then you have a wick. So the wick shows how far price has traded above and below the candlestick body. So the candlestick body is essentially where the green color, okay, is, and then for the bearish candlestick is going to be where the red body is. And then now on the ends of the bodies, you have these little lines that are called wicks that show that price was essentially up at one point, but it kind of actually went ahead and pulled back. Okay, so one candle alone is not a strategy. Traders look at structure, levels, and context. Okay, so just looking at candlesticks is just not enough. Okay, but it's very, very important to learn how to actually read them and learn how to actually go ahead and identify them. Next, so one strategy that I like to use when it comes to trading in the foreign exchange market, and I believe is very, very beginner friendly, is something that's called support, resistance, and also utilizing market structure. Okay, so within the foreign exchange market, and when you're looking on the charts, okay, support is an area where buyers have previously shown interest. So what I like to basically do is I like to actually go ahead and compare support to as a floor. Okay, so when price comes to support, it rejects off of that area multiple times because that shows that traders are finding interest in that particular area, and it acts as a floor. Okay, and it's holding that area. So for resistance is an area where sellers have previously shown interest. So the same exact kind of thing as the support, but for resistance, I like to compare it as a ceiling. So let's say you jump up, all right, and you hit your head on the ceiling. What's going to happen? You're going to come back down. Okay, the same exact thing for support. Let's say you're going to go ahead and jump up, okay, and then what happens when you land? Okay, you're going to hit the ground, which acts as a support. So support, resistance, support, resistance. So resistance is where sellers are interested at. Support is where buyers are interested at. Okay, an uptrend often forms on higher highs and higher lows. Okay, higher highs and higher lows. A downtrend often forms on lower highs and lower lows. Okay, so what you want to do is you want to treat levels as zones rather than magical prices. So within these support and resistance areas within the market where you see price has came to, multiple times, okay, you're able to actually go ahead and utilize that as a zone and not just at a particular price, okay? So now the next thing what you want to do is utilize support and resistance. Okay, you want to use a strategy, and one of the strategies that I like to use, especially that I learned when I first started and still use it to this day, is a strategy called the break and retest strategy. Okay, and this is a beginner concept for the simple fact that it's very, very simple. Okay, so once you're able to actually go on the chart and mark up your support and resistance, okay, what you'll do is you'll wait for price to actually go ahead and approach an important support or resistance. So like I said, if prices are reporting support, you know that buyers have interest at that particular support. If you see it approaching a resistance area, you know that sellers have interest at that particular area because it has probably showed you multiple times that whenever it reaches this certain support or resistance, it goes the opposite direction. Okay, the next thing you want to do is you want to have a break, okay, in a support or resistance. But now once you have the break in the support or resistance, what you want to do is you want to wait for a retest. Okay, so for a retest, price returns towards the broken area. So let's say we have price break or resistance, we want to wait for price to come back and return to retest it and give us a confirmation to actually go ahead and enter the trade confidently. Okay, so traders then watch for confirmation that the old level may act as a new support. So let's say if we break a resistance, okay, so now let's say you're in an apartment building and you go ahead and you jump up and you hit the ceiling, right? But this time, instead of hitting the ceiling and coming back down and resisting, you break through the ceiling, okay? Then now, once you break through that ceiling, okay, above you, right? Let's say someone lives above you. Above you, now their floor, okay, will act as your floor, which is basically your support. So now supports and resistances can also switch. So if you break a resistance can now then become a support. If you break a support can now then become a resistance, if that makes sense. Okay, so a retest is not guaranteed, and a break and retest can fail. So when you actually go ahead and trading within these markets, there is no strategy that is 100%. If you're watching videos on YouTube or you hear people saying, you know, they have this, that, whatever the case may be, they don't lose, they're actually lying to you. Okay, they're actually lying to you. There will be a time where you will actually go ahead and take some losses, okay? Because no strategy within the foreign exchange market or just trading in general is 100%. So the next thing we want to talk about is when you're entering your trades, you need something that's called a stop loss and a take profit. So a stop loss defines where you plan to exit if the trade idea is wrong. So let's say I'm looking for a buy at 100, okay? And I see in the market, if price goes to 90, I'm going to put my stop loss there because if price goes to 90, I want it to automatically take me out of the market for the simple fact that I know that my trade idea is reversing and it's actually wrong. Okay, so the next thing is that you need to learn is a take profit level. So take profit defines where you plan to close some of all of your winning trade. So like I said, for the same exact example, let's say I'm entering at 100. Okay, my stop loss, I see that the market could potentially go to 110. So I'm going to put, my take profit, sorry. Let's say my take profit could potentially go to 110. So now I'm going to put my take profit at 110. So now when the market actually goes ahead and reaches the price of 110, it's going to automatically take me out my trade with my profit. Okay, so stops should actually be planned before entry and paired with appropriate position sizing. So as I'm going along and showing you guys and breaking this stuff down, you can see how all of these things start to tie together. Okay, so you can see how your lot size matters. So now your lot size, okay, is going to determine how much you're actually losing. Okay, your stop loss and take profit, what you're going to be putting on, is going to determine how much you're going to be making and how much you're going to lose if the price doesn't go your way. Okay, so something that you need to know, that the market gaps and slippage can cause execution away from the requested stop price. So the market can sometimes be volatile. So let's say, okay, I want to enter at price 100. Sometimes it might enter me at price okay, one-on-one, okay, one-on-one. So sometimes it's very, very important, to find a broker that actually goes ahead and has very, very good, okay, slippage and very, very, very good, risk and things of that nature. So next thing we're going to be talking about is risk to reward ratio. So I want you guys to understand that when it comes to trading, I like to tell people that you need to have enough, or I want to say have enough. You need to make sure you have money in your account to basically, be there for the long run. So what do I mean by be there for the long run? So you need to actually learn something that's called risk to reward ratio. So risk to reward compares the amount you plan to risk with the potential reward. So for example, let's say we want to go ahead and a specific trade, we're risking $50, okay? But now we're risking $50, but our take profit is going to be 100. So now what that means is that now we have a 1-to-2 risk to reward trade. So now let's say we actually go ahead and hit take profit. Okay, I risk 50 to make 100. So that's a 1-to-2. So now let's say that next trade I risk 50 to make 100 again, but I actually go ahead and lose it. Now I'm actually still in profit $50, if that makes sense. So we don't want to actually go ahead and risk our whole account. We want to basically have proper risk management, and we want to make sure that we're risking, okay, whatever we're risking, we want to make sure we're making at least 2 times of that, okay? So a favorable ratio does not guarantee profitability, win rate, execution, or cost, and cost still matter, okay? Do not move targets or stops randomly just to force a certain ratio, okay? Cool. Next thing, trading sessions. So this is very, very important, and this ties back into, okay, why the foreign exchange market is open 5 days a week, 24 hours a day. So you're actually able to make money at all types of day, and here's exactly why. So there are different trading sections within the foreign exchange market, okay? So Forex activity moves through major global sessions, including Asia session, London session, and New York session, okay? So there's also a Sydney session and stuff like that, but nobody really trades it, okay? But one thing that you need to know, the Asia, London, and New York session are one of the most volatile sessions. And the reason why these sessions are active and some are more active than others, because let's say, okay, it's 8 a.m. Eastern time over here in, New York, okay, Eastern time. But in Asia, it can be nighttime, and you're still able to make money no matter what, no matter where you are. Let's say you're taking a trip to, the UK. You're actually able to trade the London session. You get what I'm saying? So this is why I believe that the foreign exchange market is very, very powerful, because you can make money no matter where you are in the world, no matter what hour of the day it is, as long as it's Monday through Friday. Okay? So now, next thing, different currency pairs can behave differently depending on which financial centers are active. So if I'm going to be trading in the London session, I'm going to be trading pairs like Euro USD, GBP JPY, because why? The Euro and the GBP are most active, okay, in the London session, because that is where the currency is mainly being used. Okay, so now let's say we have the New York session. I'm going to be trading pairs like USD JPY. You can still trade USD CHF. A lot of different things. I'm going to be trading gold during New York session, because that is when a lot of traders are active and you're actually able to see the most volatility. Okay, so London/New York overlap can bring a higher activity in any major pair. So London session, as of right now, before daylight saving and things of that nature, starts at 3 a.m. Eastern Standard Time over here in the States. And then New York session starts at 9 a.m. Eastern Standard Time over here at the States. So between 9 a.m. and 12 p.m. Eastern Standard Time, there is a London and New York session overlap. So this will mean that there will be a lot of high volatility pairs where you're going to actually go ahead and benefit and make some money off of, okay? So more volatility can create opportunity, but it does also create higher risk. Okay, risk to reward. Okay, one thing that I want you guys to understand about trading is that you're gonna have to be okay with risking some money to make some money. Cool. Next thing that you're gonna need to know when it comes to trading is risk management. Okay, so for risk management, like I said, for trading, it's a long game. Okay, this is not something that you want to just be in for, a week, 2 weeks. This is a long game. So you want to protect your account at all costs. Okay, you want to protect your capital. Okay, you want to follow your plan, and you want to control your emotions. And like I said, you want to survive to trade again. You don't want to risk your whole account to actually go ahead and try to get rich overnight. That's not how trading works. And trust me, that is not a sustainable way to trade. Okay, so what you want to do is you want to decide your maximum risk before every trade. Let's say I have $100 in my account and I see a potential trade setup. So I'm saying, all right, I'm going to risk anywhere from 1 to about 10% of my account. So that would be, I'm going to be risking anywhere from $1 to $10, okay, on a potential trade. But now if I'm risking anywhere from $1 to $10, my profit is going to be at least double that. So let's say I'm risking $10. I know my take profit is actually going to go ahead and be $20. You get what I'm saying? So we're not trying to risk the whole $100 just off one trade, because we need to survive to trade again. Okay, so the next thing you need to do is use a stop loss and calculate your position size around your lot. Set daily and weekly loss limits. So for me, I know I set certain weekly and daily loss limits. I know for sure as of right now, my weekly loss limit is about $1,000. So for me personally, I don't trade every single day. I may find, a trade, 2 to 3 times a week. But I know that if I reach my $1,000 that threshold that I've lost, I'm done for the week. I'm coming back next week to try it again. Okay, so the next thing you want to do, not revenge trade after losses. So let's say I actually go ahead and do lose $500 in a day. I'm not gonna go ahead and keep trading, trying to get that money back right then and there. I'm gonna wait a day or two, okay, clear my mind, go over a few things, and actually go ahead and wait for the next valuable setup for me to go ahead and make my money. Because now, let's say I lose 500. Now that next trade that I'm looking at, I'm going to be risking another 500 to potentially make 1,000. So now then I'll be able to make my money back, if that makes sense. Okay, so what you want to do is do not increase size simply because you feel confident. So just because you feel like, this trade has to go my way, this trade is going to go my way, don't just get too antsy. It's okay. You want to create a plan, you want to control your emotions, and you want to basically go ahead and do things that are repetitive. Okay, so the next thing you want to do is, before you actually go ahead and open a live trading account, you can actually practice on a demo account until you understand how to actually enter, risk your calculations, put your stop loss, take profit, so on and so forth. So this is one thing that I also like about learning how to trade. You don't have to go ahead and jump straight into trading live. You can actually go ahead and trade demo account before actually going ahead and doing that. Okay, so now one thing I want to say is, okay, below in the description there will be a link to my free Telegram where you can actually go ahead and join, and I'll show you how to actually go ahead and make a trading account, and you'll get access to 100 plus free trading videos, and you'll get access to free calls, free signals, so on and so forth. But all you have to essentially do is join the Telegram in the description below. All right. Boom. Next. The next thing you do is you need a simple beginner trading checklist. Okay. So the first step that you need to identify is, what pair are you trading? Whether it's gold, whether it's Euro USD, GBP, JPY, GBP USD, there's a variety of pairs that you're going to be able to trade within this market. 2, what is the trend of the market? Is the market going up, which means the market is bullish, or is the market going down, which means that it's bearish? So if the market is going up, I'm going to be looking for buys in the market. If the market is going down, I'm going to go ahead and be looking for sells. 3, where are support and resistance areas? So you're going to have to basically identify where has price made a lot of support and a lot of resistance, and you can mark those areas out. What is my confirmation entry? Am I looking for rejection candles? Am I looking for liquidity sweeps, so on and so forth. Okay, as time goes on and you start learning a strategy, you'll be able to identify all these different steps. So where's my stop loss? Where's my take profit? Okay, how much I'm risking, and does this trade follow my written plan? So like I said, before you even start trading live, if you have no idea where you're going, what to do, you can literally start a demo and start practicing all these different types of things, practicing strategies, so on and so forth. If you want, you can also look at my channel. I have strategies that you're going to actually be able to go ahead and benefit from and learn also, okay? So next, a beginner's mistake to avoid, okay? So when you're first starting off, the one thing that a lot of people do is they experience something that's called FOMO. So what is FOMO? FOMO is fear of missing out. Okay, so they'll see a break of support, they'll see a break of resistance, and instead of waiting for the retest and the entry confirmation, they'll just try to go ahead and enter because they think that the market is going to leave them. But I'm going to be the first to tell you that the market will never leave you. Okay, there will always be opportunities throughout the week, throughout the day of the week, for you to actually go ahead and find trades, right? There's times where I missed a trade while I was asleep. Okay, no worries. Let me just wait for the market to settle down. And I know that the market will go ahead and help me find another entry point or find another setup. The next thing is over leveraging. We don't want to over leverage. Like I said, if we're risking $10, we want to stick to a certain plan until we start getting better and better and better and comfortable where we're actually able to raise our risk as our account continue to grow. Okay, next thing, no revenge trading. Like I said, if you lost, you don't need to make that money back right then and there. There will always be another day. There will always be another trade. Okay, next thing to avoid, having no plan or no strategy. Okay, so using oversized leverage, taking too many trades at once. Okay, chasing price because you fear of missing out. Like I said, copying someone else's trade without understanding the setup. So you guys might be in, these different communities and all these different types of things, and somebody might send a signal or the trade setup, and then you might think like, oh shoot, let me just take the trade that they're going, and then you lose. No, it's always better to actually go ahead to take signals and trades from people who are actually go ahead and making real money from it while you're learning, or just sit back and just ask them questions. Hey, why did you mark this up? Why did you do that? So just because someone in the community sends a trade or whatever the case may be, doesn't 100% mean you have to take it while you're just getting started, okay? Focusing on only profit instead of the process and risk, okay? So one thing that I see is, like I said, this is not a get rich quick. Can you make money fast? Yes, depending on the individual's learning curve and how much capital they have to invest, so on and so forth. But this is not a get rich quick. We want to make this, okay, something that we're going to be able to do for the rest of our lives. Cool. Next thing, okay, your learning roadmap. So step one, what you want to do is you want to create the foundation, all right? You want to create a foundation. So step one, learn currency pairs. Learn about pips, learn lot sizes and order types, okay? 2, okay, you want to learn about candlesticks, okay? There's different variety of candlesticks that you want to be learning, okay? There's different shapes, there's different, names for certain candlesticks that can actually go ahead and help you, okay, in basic market structure, okay? So now that is basically kind of the foundation when it comes to learning how to actually go ahead and trade. The next thing that you want to do is find a strategy. You need to find a strategy that's going to be beneficial and profitable for you. Something that's simple for you, okay? Because there's thousands and hundreds of strategies out there that me personally that I came across, but some of them just didn't make me comfortable. I didn't feel like I understood enough. And everybody's thought process is different, okay? The next thing you need to do is step 3, mark up your support and resistance. Learn how to spot support and resistance within the market, okay? Step 2, practice one setup, such as a break and retest, okay? Like I said, you can practice on a demo before going live, okay? Step 5, build strict risk management rules, okay? Learn how to actually go ahead and not risk your whole account every single trade, okay? Not how to risk your account every single trade, okay? I'm going to risk 10%, this trade. I'm going to risk 5%. 1%, so on and so forth. Okay, the next thing you want to do is create discipline. You need to be able to be disciplined within your mind and your body. Okay, step 6, you can also go ahead and trade, and you can actually go ahead and journal your results, review your mistakes before considering to trade live. Okay, next thing, closing, keep Forex simple, okay? What you need to do is you need to learn the language, okay? Once you learn the language, things will start making sense, okay? It's literally like being a baby, okay? Being a little kid. It's like learning new things for the first time that you never known. But once you learn it and once it's in your mind, okay, you'll never forget it. So you need to learn the Forex language, okay? The next thing you want to do is you want to master one particular strategy and one particular setup. Okay, so whether it's break and retest, okay, utilize support resistance, which is something that I use. I know there's a variety of basically a variety of strategies out there, but I just try to keep it as simple as possible. Okay, the next thing you want to do is protect your capital. Okay, protect your capital, like I said, using proper risk, not using your whole account, not blowing your whole account on one potential trade. Okay, you do not need to predict every move. You need to be you need a repeatable process and control risk. So you need a strategy and you need a plan that every time you show up to the charts, you're gonna follow this plan step by step by step. Okay, so look, one thing I want you guys to understand is that this is educational content only, and Forex trading involves substantial risk and loss. But there is potential profit and a lot of profit that you can make within this market. All right. So look, y'all, I appreciate y'all for tuning in. Please give a like, comment, and subscribe to the channel. I'm going to be dropping content daily, helping you guys start and take your trading journey to the next level. So look, I appreciate y'all. Also, click the link in the description below where you're actually able to join the free community with traders who are very, very successful. Okay, and you're going to be able to actually see the broken links in the bottom also, where you're actually going to be able to actually go ahead and start a trading account if you don't have one already. All right, so look, I appreciate y'all. See y'all in the next video. Peace.